So ASST is now above $1. Okay, it's now at $1.03. This is Tuesday, the 6th of December, 2025. Okay, we have been able to break down what's going on. Short interest is 17.17%. It's hard to borrow. Okay, we are now going to consider the option series up till the October. Okay, so they're all very much relevant. Okay, so this is what we have. January 16, this January 16 series, this will expire very soon. Okay, for the $1 strike, we have 76,702 contracts open and all of that. Okay, so yeah, you can always pause and have it read. You always can always pause the screen and read. Okay, so um, yeah, the October 16 series, it has a giant standout there. The $1.50 has an open contract of 470,993 contracts. They are all very much relevant, even though it's they are going to expire more than 10 months from today, but they're still very much relevant. They all give tailwinds because market makers are constantly buying anyway. They are getting involved, so they don't just sit idle because these contracts will expire in 10 months time. They're still very much active. So what are market makers doing right now? Okay, they're dynamically hedging a ton of upside exposure, especially on the near term January calls by buying stocks as price rises. They will dump the hedges if price falls as well. Okay, first, most of these calls are near the money. Okay, at the 1.0 at 103, 104 now, or 103. That is at right now. $1 calls are in the money, and the $1.50 and the $2 calls now have meaningful data. That means market makers who sold these calls don't want price risk. So they hedge buying shares when the stock goes up, selling shares when the stock goes down. This is the delta hedging. Why today is different relative to when the stock was under $1, which was yesterday, the pre-market session of yesterday. In our first video, the stock was at $0.96. Okay, so when the stock was at 80 cents, between 80 and 90 cents, $1.50 and $2 calls they barely mattered for hedging. Their deltas were tiny. Now at $1.04, $1 calls have high delta. Okay, I think it may be different now. What we have here, I think they ranges from between 0 point 0.6 to 0.79, depending on the volatility. Let's see, implied volatility is 189.45%. Okay, so the $150 calls, these are the deltas, so when you multiply the deltas by the massive open interests, and suddenly market makers need a lot of stock to hedge. So we have been able to break them down, not in this video. So over the last 50 trading sessions, this is the 50-day average. Market makers are responsible for more than close to half of the whole average. Close to half of the whole average. Market makers are likely responsible for that. They are likely responsible for this 50-day average. Half of it, they are likely part of it, especially going by the call series alone. Going by the call series alone, they are responsible for close to half of that volume. So the January 16 expiration is the biggest near-term driver. Okay, because hedging flows ramp up as expiration gets closer, gamma spikes near expiration. Market makers need to adjust hedges more aggressively. So over the next few trading days, you can expect fast weekly price action. If price pushes up, market makers buy even more shares. If the price drops, they unwind shares and sell. So you get exaggerated moves in both directions. This is classic gamma volatility territory. Hard to borrow plus short interest adds extra chaos. Since the stock is hard to borrow, hedging via shorting becomes difficult or expensive. Borrow rates rise. Some shorts may be forced to trim. So market makers prefer long stock hedging instead of shorting. So more mechanical buy pressure exists than usual. And if shorts feel the heat, squeeze gets louder and faster. What about the big later dates open interest, that is March, June, and October? Those matter too, especially March and June, and the huge $1 strike block. But they and on that strike we have almost 400,000 open interests. Okay, so they create a structural hedging demand over time. Okay, not the same violent gamma effect as a near-term January 16 expiry. Market makers will still hold long stock hedges for months, adjusting price as price moves. So you can see they still buy anyway. They are still hedging. They're still hedging anyway. It doesn't matter when they expire or what the expiry is. They're still hedging anyway. And there are also other series. So yeah, there's a good chance that they are probably responsible for more than a huge. Let's just say maybe up to 80% of this whole 50-day average, because we have not even considered the put series, and we have not even considered the longer term series as well, the ones that are going into 2027. So longer date open interest, persistent hedging tailwind. So that's what they are. So the longer dated open interest are persistent um, hedging tailwind. That's positive. Okay, so but short term, short dated open interest, sharp, spiky hedging waves. So those are the ones. The January 16 ones, and maybe the February, especially the January 16 ones. They are the ones that can contribute to volatility. Spikes and in the near term, short term volatility, they can do that. So you have both here. The persistent the persisting um, hedging tailwind from the longer dated contracts, and then the short dated ones that produce um, sharp spikes in the very short term. Okay, big picture. What market makers are most likely to doing right now? Accumulating stock to hedge short calls, especially the January $1 strike and the January 150 strike and the January $2 strikes, and also the higher open interest March and June strikes as well. Raising implied volatility and widening option spreads because risk is high. Rapid fire intraday hedging. Okay, every meaningful price move is equals to hedging adjustments. Yeah, this makes every uptick or downtick feel bigger than it should. Okay, okay. They're just buying when delta increases. So when the delta increases, they buy. Okay, selling when the delta falls as well. Okay, so the delta. Let me show you the delta here. Okay, I don't know if it's going to come up. It may not come up. Let's see whether it's going to come up. Yeah. Okay. So this is the delta here. This is the delta. Okay. So you can see for the $1 strike it is 0.61. So this means that what you multiply, this is the, if you want to find out the number of shares that they're going to buy, it will be multiply this by 100, and then you multiply by 0.61. So ultimately you'll be multiplying by 0.61. That will not, so you would normally you would expect that they will buy something 7.9 million shares. No, they wouldn't buy. They would actually buy around 600,000, 6 million shares or thereabouts. So you multiply this by You multiply this by the delta. They multiply the open interest by the delta. Here they will buy 500,000. Here they'll buy 500,000. So as the price goes up, then they will keep it. For now, they wouldn't have bought up to 79,000. But as the price keeps going up, then the delta will continue to increase. That they will continue to buy as well. So this is what we're talking about. As the price goes up, the delta increase keeps increasing, and then they keep on buying. Right now, they don't need to buy much. They don't need to buy much here. You can see that they don't need to buy much here. So you multiply this by 56,000 by 100, and then you also multiply by 0.03, then you ultimately get what they are buying. Okay, so as the price goes up, this delta increases, and then they keep on buying. They have to adjust. If price pushes above 1.05 to $1.10 to $1.20, market makers need more hedge stock. You can see that's the same thing I'm talking about, because when the price keeps moving up, then the delta moves up as well, and then they are forced to add more. So buying pressure is always there. So up moves can get self reinforcing, especially while January calls are alive. But if the stock breaks under $1 hard, they unwind hedges, selling pressure increases. So pullbacks can be steep and fast too as well. Okay. So in plain English, market makers right now are basically saying we sold a mountain of calls. If this thing goes up, we have to buy shares. If it drops, we'll dump them. And until January expiration passes, we're glued to our hedging screens. Volatility is not a bug here. It is the mechanism itself. Okay, so far so good. Bitcoin has upper projections of up to 100,000 and one. Yeah, there's a good chance ASST may also that may also serve as a catalyst as well. Yesterday it gained 19%. Yesterday it gained 19%, was it not? Yesterday they 19.13%. Yeah, and that today is up 0.97%. So all of those are catalysts outside what is going on its options. So see what you make of what's going on with ASST, and thank you very much for watching this video.